I'm Emily Chang, and this is the best of Bloomberg Technology, where we bring you all our top interviews from the week in tech. Coming up, another cyber attack cripples companies from Russia to Western Europe and the U.S. McAfee CEO Chris Young joins us with his take on the latest ransomware and how to contain the spread. Plus, Google's search for answers and an appropriate response after getting slapped with a record antitrust fine in EU history. We discuss the next steps for the search giant. And the iPhone turns 10. We'll take a look back on how the device changed the world as we know it. First, to our lead. A cyber attack similar to WannaCry spread around the globe this week, infecting computers in dozens of countries, port operators in New York and Rotterdam, government systems in Kiev, and companies like pharma giant Merck, advertiser WPP, and shipping behemoth Maersk, all victims. The attack is being carried out by a virus called Petya. The ransomware locks infected computer systems and demands users to pay $300 in Bitcoin to regain access. We spoke to McAfee CEO Chris Young about the severity of the attack and what can be done to prevent future breaches.
The real story here is the evolution of ransomware. We did see a global ransomware attack, but the way we've seen this attack work is we've gone from single instances where users would get phished to now you've got hybrid attacks where this exploit, this ransomware attack used an exploit that we saw in the WannaCry attack a few weeks ago, but is now using different types of exploits to go after user credentials and even attack machines that aren't necessarily unpatched, which was the case in WannaCry. So we're now seeing the evolution of ransomware where they're trying to move from individuals they go after to really trying to infect entire networks. And that's what we started to see with WannaCry, and we're seeing the next step of the evolution here with Petya.
So in this very moment, what should companies be doing to protect themselves?
So the number one thing they can do is make sure that they're patching the vulnerabilities that they've been alerted to in their environments. Second thing they need to be doing is making sure that they're updating all of their cybersecurity defenses. So make sure they've got the latest versions of the cybersecurity software working. Make sure they've got adequate monitoring and alerting capabilities in their organization. Make sure that they've got a users alert on the alert for these kinds of attacks as well. Users can be a really good, important source of intelligence when these kinds of attacks happen.
Why are ransomware attacks becoming so popular among hackers?
We believe it's a few reasons. Number one, there is an opportunity in this case for the ransomware attackers to monetize the attack in different ways than we've traditionally seen when they used to just go after stealing sensitive information. In this case, they don't actually have to steal any information. They can simply propagate their malware and look to receive payment in order to allow the user to move forward in using their machine. But we also believe that what we're starting to see here with WannaCry as well as with Petya is a move to try to test what's possible, and that perhaps they're looking for a bigger prize down the line by infecting entire organizations whose operations can be disrupted by these kinds of attacks. So we don't think we've seen the end of the movie here. We think we're just starting to see the beginning chapters of the movie.
Well, goodness then, how does the movie progress and how does the movie end?
I never like to try to predict the ending of a movie, but I can tell you this. We do expect to see more attacks like this. We do expect that the ransomware purveyors will try to use other forms of propagation, use other forms of stealing credentials, which is what we're starting to see here in Petya versus what we saw with WannaCry. And so we expect that they're going to test different methodologies and see which combinations work best for them, and then ultimately seek to monetize themselves. In this particular case, for example, many of the Bitcoin wallets were hard-coded into the software itself, and we've only seen small amounts, less than $50,000 worth of payments go into those Bitcoin accounts so far. So we expect to see this continue to evolve, but again, we believe this is something that's just beginning, and that we've got a lot more of these kinds of attacks that we'll experience over the course of the coming really months and into the next few years even.
So what do you think is driving these cybersecurity stocks down, whether it's Symantec or FireEye or Checkpoint?
You know, I have the luxury of being a privately held company, so I'm not focused on stock price. But you know, what I think we really are seeing here is a call to action for the industry. You know, those who are cybersecurity practitioners, you've got to move to the next generation capability of cybersecurity products that are out there. A lot of our newer technologies were kind of at the front and center of being able to detect and stop these kinds of attacks. Patching continues to be a very, very important part of not only good IT hygiene, but good cybersecurity hygiene. And as I mentioned a little bit earlier, users are important. Users tend to see these things early, and they can be a really, really important source of early warning when your organization may be vulnerable to an attack. So a holistic cybersecurity program, working closely with vendors, working closely with employees, and really driving a full life cycle approach is what's very important for anyone who's responsible for protecting their organization.
Well, a record antitrust fine by the European Union as it issues the first penalty in a 7-year investigation of Google's dominance in shopping search advertising. The EU slapped Google with a $2.7 billion fine for abusing comparison shopping search results. Now Google has roughly 3 months to stop favoring its own service or face more sanctions. The regulator at the heart of the battle, EU Competition Commissioner Margrethe Vestager, spoke to Bloomberg Television and laid out the evidence against the company.
What we have found and studied intensively, I think with 5.2 terabytes of data, is that there is a very close relationship between visibility and traffic and revenue. So what you see is that Google have taken an advantage for its own shopping comparison on the cost of its rivals, and being able to do so by misusing the dominant position in general search. And that is, of course, the key of the case, that we have found Google to be dominant. And with dominance, of course, comes a special responsibility to compete on the merits.
Bloomberg's Caroline Hyde sat down with Richard Stables, CEO of Kelku, one of the first companies to sue Google on these grounds.
Kelku basically started in '99, and it grew up to be probably the leading price comparison site in Europe. It was the dominant. It was we were in 7 out of the 10 countries. We were the leading price comparison site, doing really well. Everybody heard of us. We were well known in the UK, and then Google basically decided around 2005 or 6 that suddenly these vertical search players, these shopping price comparison sites, were a threat, and they started to systematically figure out how they were going to take us on. And what they decided to do was they were going to go to merchants and say to them, give us your feeds, give us everything from you, and we will send you traffic for free. First, we weren't worried. And then a series of algorithms hit in 2011, and our traffic literally fell off a cliff.
By how much?
So since 2011, we've lost 95% of our traffic that's come from Google. And we're not the only ones. I don't know of a single price comparison site that hasn't either been smashed to the tune of 90 or 95%, or at least 60 or 70%. And there's bodies littered all over the place. And they're not just talking about European price comparison sites. We're talking about American companies here as well.
So when you hear the allegation that potentially, Margaret, yes, Vestager, once again, the EU is being too tough on big US giants, what do you say?
I think that's absolute rubbish. I think she's got the decision today absolutely right. I think that Google will try and make this out to be USA versus Europe. They'll try to say it's the big old bad commission. That's absolute rubbish. It's all about Google hurting consumers, and the commissioner has done a fantastic job today.
Consumers?
By removing competition in the marketplace, you've essentially you're raising prices because merchants have nowhere else to get traffic from. So they're basically the only place they can really go to is Google. And the price goes up. You've got no competition, you've got no innovation. So back to your question about why is this not a US versus Europe thing, there are numbers of CEOs who've come out yesterday saying they support the commissioner. We're talking about CEOs of Oracle, Getty Images, News Corp. There are lots and lots of companies in America have been impacted by Google and are very, very happy to see this decision today.
What can Google now do to rectify the situation, in your point of view?
So Google, as the Commissioner said, has been given 90 days to come up with a proper fix to this market. And they'll come back within 60 days. And I think the right thing to do is to turn around and say, look, if we're preferencing our own systems at the top of Google, then we've got to give some of that real estate to the other players. So that's one of the things. But Google are facing much bigger implications here, because this is a watershed moment. This is the first time that somebody, a big authority, has come out and said, Google, you've broken the law. Your core values are not what you hold them up to be. The do no evil, the sanctity of your search is in question, totally in question. And you put profit ahead of what's good for consumers. And frankly, they're going to have to change their business, not just in shopping, but in things like travel, in local, in news, in maps. This is a potential decision that can impact right across the EU, but also in the wider world.
What about your own lawsuit? What was it, 2015, when you first came and said, Google, you owe us? Are you likely to get money back now? Are you likely to pursue that legal investigation now that the EU has ruled?
So I can't talk specifically about the case, but what I will say is the following, is that it is a case following on from an EU decision, and we will definitely be pursuing that with a vengeance now that this decision has come through. And you know, we went to Google and said, look, you've done wrong. This is some of the evidence that, and certainly the EU case was part of that. And we will have our time in court. We will not be the only ones, though. There will be a lot of other players out there who are going to go after Google. A lot.
Coming up, our exclusive conversation with Forerunner Ventures founder and managing director Kirsten Green. Her outlook on e-commerce as consolidation grips the sector, and more partnerships as self-driving tech heats up. Avis signing a deal with Alphabet self-driving car unit Waymo, and Hertz teaming up with Apple. What do the deals mean for the future of autonomous tie-ups? That is next. This is Bloomberg. Online retail is expected to grow 8 to 12% in 2017, according to the National Retail Federation. That's up to 3 times higher than the growth rate of retail overall. One person that knows a thing or two about the sector is Kirsten Green. Green made her name by investing in a couple of e-commerce unicorns, including Dollar Shave Club and Jet.com, 2 of the biggest e-commerce exits in the last few years. Green founded the venture capital firm Forerunner Ventures, which also counts Bonobos, Holler, and Birchbox among its portfolio companies. She joined us in the studio, and I asked her why she decided to bet big on e-commerce.
The consumer's path to purchase is really being completely reimagined, and a large part of that is being driven by digital attribution, digital technologies that everyone's adopting, and I think that's really shaking up the landscape.
So you invested in Jet, which sold to Walmart for $3 billion, Bonobos, which just also sold to Walmart, Dollar Shave, which sold to Unilever. What did you see in those companies early on?
I think actually, you know, most of the things that we're investing in have a root business in selling discretionary items, and a lot of the path to purchase around discretionary spending has to do with engagement, experience, and bringing something to life that has some element of entertainment or connecting personally to a customer. So in each of those instances, I think we felt like the founding team had a unique take on the consumer, on how things were shifting in the ecosystem, on how they could use technology to give a better experience, and really a better business model too. I mean, I think the backbone behind a lot of the companies we're investing in are what's the platform that they're building off of, how are they creating a better experience and a better business model leveraging technology.
So we've seen spectacular successes in e-commerce, but also spectacular failures. I'm thinking of Fab.com. What are we going to see more of?
I mean, e-commerce, or commerce speaking, is a hard category, like many areas of business are, and I think that, you know, there are success stories and there are failures, and I guess if I had to try to understand like some of the core differences between the companies that fall into each of those buckets, I would lean on the fact of experience, like on how close in touch they are with the consumer, how much of the core offering and the core service proposition is really supporting the product that they're eventually selling or the consumer that they're addressing.
Amazon is making a big bet on Whole Foods, surprising a lot of people. They're getting into clothing. How do you know what Amazon is and isn't going to do? Because you don't necessarily want Amazon as your competitor, right?
I think you have to, I mean, we just operate in a world where Amazon is a formidable competitor. We assume that they're thinking about how to address the consumer very holistically from every angle, and try to understand, are there opportunities to play off of that strength that they have? They really are an aggregator of demand. And is there an opportunity for a company to use that as much as, you know, not for it to just be a competitor, but is there a way that they can play in that ecosystem too?
Then you have, you know, some of the biggest online players, including Amazon, moving into brick and mortar. Amazon's opening stores, Bonobos has stores, Warby Parker. Why is that?
There's been a lot of conversation for a handful of years about omnichannel, the importance of omnichannel. I think we're just starting to see it play out, really. It's not about having a couple of stores and having an online site, but it's really about thinking, again, about that customer's path to purchase, about where are all the ways in which she or he might expect to interact with your brand, your product, your offering. And the reality is the consumer is everywhere, and the consumer wants what the consumer wants when they want it. And to really build a big business and to meet that demand, you need to think about how you meet the consumer in all those different places. And sometimes that means you do transactions online and experience offline, and sometimes it's the reverse and everything in between.
So what's the next big thing for Kirsten Green? I mean, where are you looking for the next wave?
We're you know, grounded, I think, in the idea of like who is building a better model for bringing these businesses to life. So much of the consumer ecosystem and how they make decisions have changed. That's really impacted the power of a product, the power of a brand. I think it's gotten a lot more complicated. It's no longer, we really think about having a great product and having a value proposition as table stakes. And really to get the win is to have that plus a great service. And a lot of that has to do with kind of helping them filter through the clutter, being convenient, being personalized, increasing. And we're, you know, many businesses are on stages of meeting those demands, but there's still a lot of opportunity to meet those.
That was Forerunner Ventures founder and managing director Kirsten Green. Well, in the auto space, shares of rental car company Avis jumped as much as 21% Monday after reaching a deal with Alphabet's self-driving car unit, Waymo. As part of the partnership, Avis will service and manage Waymo's fleet of about 600 cars in Phoenix. And just hours after the announcement, we learned that Apple is working with Hertz to test self-driving technology in a small fleet of Lexus SUVs. We asked Bloomberg Tech's Alistair Barr and Alex Webb if more partnerships are expected.
In Phoenix, there's these 600 autonomous vans that Waymo has, and they're testing them out with volunteers. And basically, when the cars are finished for the day or the night, or when something breaks, basically Avis will be responsible for all that type of thing, making sure they're clean, stuff like that.
And with Apple?
With Apple, it's a lot smaller. It's basically that Apple, they've got a lot of very highly paid engineers. The last thing they want to be doing is having those guys looking after doing the mechanics of their cars. So they lease these cars from Hertz, and Hertz is therefore responsible for that upkeep.
So how big a deal are these partnerships generally?
I think what's really interesting about it is that if you look at some of the really important financials in this whole space, the big risk for people owning huge fleets of cars is, as you know, when you buy a car from one day to the next, its value falls like $10,000, right? So if you are not owning those cars, but someone else owns them, that gives the potential that that sort of depreciation is on someone else's balance sheet and not your own. That can help keep your net margin very high. Now, of course, Alphabet still owns these cars, but it hints at a broader agreement with Zipcar, which is the unit of Avis, and that might be what is keeping people optimistic from the Google side.
What do we know about exclusivity here?
Yeah, they're not exclusive, and Google often does these types of deals where they never like to be tied down like that. But from the point of view of for Avis, it's very interesting because they have basically cars that do millions and millions of miles every year, and Waymo needs that type of data to train its AI and its self-driving software. So it could work quite well. And if any whiff that Avis is involved in that type of technological transaction, that's very good for Avis.
Are we expecting to see more partnerships in this area? I mean, Uber has been a bit distracted. I mean, but what could we see when it comes to the other players? I
mean, in some ways, we've seen some of this stuff already. Daimler did a €1 billion deal last year to acquire a fleet management company called Athlon Car Lease International. Bit of a mouthful, but they've done a very similar deal in the space. The other element, of course, is a lot of tier 1 automotive suppliers, people like Bosch, Continental, Magna, they're really trying to build out their aftermarket business, because a car might do, because it's always going to be in use, a lot more miles in any given year. So the replacement business for seats and clutches and all these kind of very nitty-gritty components, they'll be replaced a lot more frequently, which is a huge opportunity for the people who maintain these vehicles.
Coming up, Blue Apron makes its public debut. We discuss the startup's IPO journey and the challenges ahead. And insight from outer space on the new age of discovery. NASA record holder Peggy Whitson joins Bloomberg from the International Space Station to break down the new race to orbit new worlds. This is Bloomberg. Well, Blue Apron jumped into the public markets this week, now trading on the NYSE under the ticker APRN. We spoke with Bloomberg News IPO reporter Alex Barinka after the company wrapped up its first day of trading about Blue Apron's IPO journey and its challenges ahead.
Looking at the trading today, the fact it was actually unchanged. It closed at $10 a share. We had some aftermarket trades at about $9.95 below the IPO price. It seems like there's a bit more investor concern baked in as well. The initial valuation they went out at a $3.2 billion market value at the high end, that's what they were trying to get when they launched this IPO, did not come to fruition. Right now they're sitting at a $1.9 billion market valuation. And if I'm an investor, I'm sitting back, I'm looking at this company, I'm saying, where's the growth? And I'm saying, how are you going to afford it? Because frankly, when I look at this cash position, it seems like they actually might need some money soon. So some of that could be playing into this downward or very flat pressure for Blue Apron shares.
David, should investors be concerned about Blue Apron simply because of Amazon, Whole Foods, or because of all these other things that Alex has mentioned?
Well, I think that if I were in any kind of food delivery related business, I would be watching Amazon with incredible care. And the fact that they bought Whole Foods, which surprised most of us, I think just goes to show the seriousness with which they view food as you know, part of their conquer the world and all the world strategy. So yes, I do think so. I think they should worry, seriously.
Alex, should there be any more scrutiny on how the bankers handled this IPO in particular, not knowing that Amazon Whole Foods was coming?
So it seems like they did what they had to. I've been talking to folks who are around the deal, not around the deal, who are in the industry, and look, if they launched the deal when they did 3 days after the Amazon announcement, or if they waited until perhaps after Labor Day, this idea of Amazon Whole Foods is still going to be there. The valuation they went out at is very strong. As we talked about, it was valued at more richly than most of the e-commerce companies out there. So the valuation point made some folks scratch their heads. So it seems like they did what they needed to do to get the deal done. And frankly, Blue Apron needs cash. If you look back at their first quarter cash situation, they had $61 million on hand. They had free cash flow deficit of $74 million in that quarter. And they told investors in the S1, look, we have cash and borrowings to get us to at least 12 months of runway. That's not a ton of time. So this is a company that is having to outmarket its competitors, now being Amazon, Whole Foods, and others, and is continuing to try to build out its logistics network and its fulfillment centers. So they needed the money. So whether you wait a few months or you go out now, it's always going to be a question of valuation to actually get the deal done.
Coming up, Apple celebrates the 10-year anniversary of the iPhone, but will it continue to be the company's moneymaker? We'll hear from one analyst who thinks another Apple device could take its place. And a reminder, all episodes of Bloomberg Technology are live streaming on Twitter. Check us out at Bloomberg Tech TV weekdays, 5 p.m. in New York, 2 p.m. in San Francisco. This is Bloomberg. Welcome to the best of Bloomberg Technology. I'm Emily Chang. This week marked the 10th anniversary of the iPhone. While it wasn't the world's first smartphone, it jumped far beyond the competition and propelled the mobile revolution. The device spurred rapid changes in industries of all kinds and society as a whole. Here's a look back at the decade of the iPhone.
Today, Apple is going to reinvent the phone.
On June 29, 2007, consumers got their hands on the very first iPhone. Now, a decade later, the smartphone has proven to be the undisputed king of Apple products and in turn revolutionized an entire ecosystem, destroying heavyweights of the day and spurring new rivals across the globe like Oppo and Xiaomi. The iPhone also opened doors to what has become a large chunk of the company's revenue, apps. App sales have generated roughly $100 billion in gross revenue for Apple, with more than 16 million developers worldwide producing apps ranging from Uber to Snapchat. The launch of the iPhone didn't just change the way people work and socialize, it also transformed the company itself. Apple grew by every dimension, going from a company with staff of around 18,000 pre-iPhone to a workforce of 116,000 in 2016. And sales for Apple went from $19 billion in 2006 to over $215 billion a decade later. It doesn't stop there. Since its launch, Apple has sold about 1.3 billion iPhones, generating more than $800 billion in revenue. That blows other iconic devices out of the water, including Nintendo's Game Boy, which sold over 118 million units in its lifetime, and Sony Walkman, which sold a little over 200 million in a 38-year period. But with that astronomical growth rate comes heavy dependence. The iPhone makes up a whopping 63% of revenue for Apple, making it the company's most crucial product. Some tech heavyweights are sounding the alarm about the future of smartphones, with longtime Silicon Valley investor Peter Thiel saying he doesn't think there will be any more innovation here. It's clear that Apple CEO Tim Cook sees it differently.
I think we're just getting started. And so I'm incredibly excited, and clearly there's nothing that I think virtually anybody would say is going to replace a smartphone anytime soon.
As Apple looks toward the next decade and the competition stays red hot, a major question remains. How long can the iPhone remain at Apple's core?
So what is the outlook for the iPhone? Well, Loop Ventures co-founder and former Apple analyst Gene Munster believes sales will peak in 2019 and will be replaced by an entirely new product. He joined us along with our Bloomberg consumer tech reporter Mark Gurman.
What we do know is they've launched ARKit. We know that the next iPhone is going to have a 3D mapping chip that's going to be especially geared for a premium AR experience. And we know Apple's done acquisitions, obviously with Mataio a few years ago, and then more recently with this Senso company. And so when you think about those three together and also think about the most logical use case for AR is some form of a wearable, despite Google's problems with Glass, it seems logical. Our 3-year is just a best guess. And so what we feel confident is that Apple is going to have this new product category, but the timing of it is a guess.
Now, Mark, you've done some reporting on this. As Gene said, Google Glass, not a success. Snapchat Spectacles, not a success. How would this be different?
Well, first of all, I think Gene's totally right. The wearables, in terms of using AR on Glass as a Google Glass-like device made by Apple, is Apple's next big product category. Of course, after the HomePod comes out. How will they differentiate? Well, Apple comes from a unique position where they're bringing the hardware expertise from making small devices like the Apple Watch and the iPhone, but they also have the software there, right? Google didn't have an operating system that it could apply to such a device. Android was still in its infancy when Google Glass came out. Apple now has this robust iOS platform that it could port to any type of devices we've seen them do in the past.
But what are the use cases, Gene? Is this something that gamers would wear or something that you think is more mainstream?
Well, I would point viewers to a story today from Johnny Evans from Computer World, where he maps out 12 use cases for augmented reality. And that's much more than just gaming. It could be anything from a remote assistant to architectural, being able to see buildings before they're designed. You could do art, medical emergency services. One that I particularly love is turning humans into robots. There's this company called Stream AR that basically allows service providers the ability to do estimates remotely so they don't have to get in their cars and drive around. I think to Mark's point is what's important here is that they have an army of developers, and we're just scratching the surface a few weeks into this, and I think that that base of developers will come up with ideas beyond what we're talking about today.
Is this something people actually want to wear? though, Mark?
That's a good question. I don't know if I would wear them, but you know what's actually really interesting? I remember Tim Cook a few years ago, before the Apple Watch came out, he was asked about wearables, and he was sort of hinting that their first wearable is going to be a watch. And the way he hinted at it is he said he wears glasses because he has to, because he can't see without them. So when these things hit the streets, there's going to be a lot of people pulling up that comment from Cook and saying that, you know, he would never wear them, and now you see him wearing them on stage. So it's going to be sort of ironic. But yes, I think there's going to be a market for it. It's going to eventually replace the iPhone. I know Gene has said this in the past. You'll be able to make phone calls from it, get maps on there, applications. And to answer your earlier question about gaming, I think gaming is going to be one component of it, but gaming is really tuned to VR experiences being fully enclosed, something that Apple was talking about with the Mac at its developers conference earlier in the month. So I don't think gaming is going to be the big focus. I think it's going to be more driving information to your eyes, quickly glancing at things, getting directions.
All right, you guys are very bullish on this. Gene, what about the iPhone? How do you expect iPhone sales to play out? I know you think that they'll peak in 2019.
So this next year, the next iPhone cycle is going to be wonderful for the iPhone. Probably units up 12 to 15% after essentially being flat for the past year. But I think that's probably the last big cycle. And I think when we start fast forwarding to a couple years from now, they're going to have difficult comps. So that naturally gets us to, this will now be, we're talking about fiscal 19, basically calendar 18, is something that's more or less flat year over year. And then you start getting into 20 and 21 where some of these wearables come out. Now, I think that the number of units they're going to sell in 2020, these are just guesses, but is very small, 3 million. So it's not going to quite erode at the iPhone, but as Mark's talking about, I think that as the utility of these wearables becomes more clear to consumers, that will start to chip away at the iPhone experience. They're both going to be around in 10 years, but the iPhone's going to be a much, much, much smaller business.
What do we know in terms of how we expect the iPhone to be spiced up this next time around?
Oh, well, it's going to be a big update. One of the bigger updates. For the first time, they're going to be doing 3 new phones. So they have the 7 and 7 Plus right now. They'll update both of those with faster processors, maybe better cameras. But then there's going to be an all-new model that people are very excited about. Some call it the iPhone 8, others the iPhone X. A stainless steel frame, glass on the front and back, sort of like the iPhone 4, curved glass edges on both sides, and of course the heart of it will be this OLED screen, deeper blacks, deeper whites. The screen will look a bit clearer, crisper. The screen will be bigger, but it's interesting because it's all going to fit in an iPhone 7 size form factor.
Now, Gene, I'm curious for your thoughts about Apple and cars. We got some comments from Tim Cook where he, for the first time, really acknowledged Apple's ambitions here. Now we know that Apple has a deal with Hertz to lease 6 Lexus SUVs to test self-driving technology. What do you expect to see from Apple when it comes to cars?
A lot of my expectations are based on great work that Mark's done around this, so following a lot of his lead. But our belief is there's 3 essential routes that they can go. One is do a car entirely themselves. The second is to do some sort of a software. And the third is probably some sort of a fleet opportunity. I've had some bad prediction around Apple and the TV, so I'm reluctant to say and put the hammer down that Apple's going to have a car. But I would say that it's very clear that this is a big market, 90 million cars sold, and that Apple wants to have a place in this. I don't think that they have their plan in place as far as how they're going to address that market. So our expectations over the next 5 years do not include any revenue from Apple Car.
And how about AirPods? Are these a sort of closet hit?
They definitely are. I think this is going to be the sneaky product over the next 5 years. I think that it's going to become much more of an augmented hearing product. We call it a hearable. And I think you'll be doing things like being able to be in a loud bar and be able to zero in on someone's, hopefully a friend's conversation, be able to tune out some of that noise around you. There's other biofeedback that they can get. They have a lot of patents around the ear canal. We think that the AirPods will be bigger than Apple Watch in the next 5 years.
I still, though, Mark, I do a double take when I see someone wearing them. They're not necessarily stylish yet.
Right. I mean, I wear them. I don't love wearing them. I think sometimes I'll even go out in public. If I wanted to wear the AirPods, I'll say, actually, you know what? I'm just going to put in the wired lightning headphones if I'm going for a jog or something. But the utility, as Gene was saying, is very strong. There's a lot they can do on the software side to improve the uses. I saw a lot of people talking about this augmented hearing concept. I think we're still early there. I think if they were going to do something big in the audio space, they would have talked about it with the HomePod. It's going to happen in the near future, but the future's long.
Coming up, as competition heats up in the cloud, Microsoft and Box are expanding their partnership. We'll get all the details from Box CEO Aaron Levie next. This is Bloomberg. Microsoft and Box expanded their deal to reach more large corporate customers with a file sharing and storage service. Customers will now be able to store their data in Microsoft's Azure cloud platform. The partnership will allow for future integration between Azure's artificial intelligence and machine learning capabilities with Box's cloud content management platform. I spoke with Box CEO Aaron Levie and asked what kind of customer demand he's expecting from this new deal.
If you look at our customer base, which is about 74,000 companies globally, including 64% of the Fortune 500, Microsoft is in, with their cloud services, in about 90% of the Fortune 500 or more. And so there's already a lot of significant overlap between our customer base and their customer base in the cloud. And we're hearing from more and more of our customers that they want to be able to leverage some of the more advanced capabilities that Azure is building and be able to have things like their data stored in more locations around the world. And that's our Box Zones technology that lets customers do that.
Now, I know you may consider using Microsoft's AI services. How would that work?
Yeah, so if you think about all the content and information that we have in Box, there's billions and billions of files, and in every one of those files are different insights and different knowledge and information. And really, the only way to extract that knowledge or information is by using some amount of advanced technology, whether that's artificial intelligence or more advanced machine learning capabilities. So things like being able to upload a video of this conversation and make it fully searchable and be able to have various tags of different content that was discussed, being able to upload audio and make that completely searchable, be able to summarize documents, be able to translate documents in text. So all of those kind of capabilities are becoming more and more readily available via Microsoft and others. And we want to ensure those capabilities are plugged into Box so our customers now can have the most intelligent way to manage and share and organize all of their content.
There's a lot of activity right now happening in cryptocurrencies, and cryptocurrency believers believe that the blockchain will one day make cloud providers obsolete and that all of the cloud essentially will be peer-to-peer. How do you think about this?
That would really be bad news for us if that happens. So, so certainly, you know, we're more in favor of the cloud model. We think that peer-to-peer has been tried a number of times over the years in different capacities, and obviously, I think from an academic standpoint, it's incredibly exciting the possibility that you could have with a completely distributed network of systems and computers that could power all the various services that we use. But there's also a lot of practical limitations between security, between reliability. That the cloud is awfully good at this point.
What regions do you expect Box Zones to expand using Azure?
Yeah, so right now it's in 8 regions globally in some of the key markets where we have a lot of customer demand. But our current customer demand in terms of where Box is being used and where customers are trained to take Box certainly exceed the 8 regions that we're in right now. So I think you can imagine us in places like South America, where we're seeing more and more traction over time, more locations in Canada, the ability to spread throughout Europe. So and then broadly in Asia, long term, we're pretty excited about the possibility of entering China. And some of the growth prospects there. So a bunch of new markets over the coming years that we're paying attention to, and we're certainly going to need to have infrastructure in those locations. And our strong preference is that we don't build that infrastructure ourselves, but we can leverage partnerships like Amazon and IBM and Microsoft and others to be able to deliver that technology to our customers.
How do you intend to navigate regulatory and censorship issues in China specifically?
Yeah, this is why it's still a pretty early conversation, but we think that there are different entry strategies that companies have been successful with. Obviously, joint ventures on the ground, being able to have isolated versions of your product. We're fortunate where the type of content that goes into Box is not the same kind of content that you generally see from a Facebook or a Google as having issues globally with. It's much more corporate information. We already have a lot of customers that use Box globally and including in China for global manufacturing processes and their global distribution networks. So our job would just be to make sure that customers can use a very, very secure, highly private version of Box in any country that they choose, including China. And we would only enter the market when we felt comfortable that we could provide that kind of service.
That was Box CEO Aaron Levie there. Well, Bitcoin's top competitor, Ethereum, had a hard start to the week. The cryptocurrency plunged more than 20% in Monday trading. The drop coming on the heels of last week's flash crash when the digital currency tumbled from over $300 to 10 cents in a matter of minutes on Coinbase's GDAX exchange. I sat down with Olaf Carlson-Wee, founder and CEO of Polychain Capital, a hedge fund that invests in digital currencies, including Ethereum, and started by asking about the flash crash that caught traders by surprise.
Last week on a private exchange, GDAX, this is actually my former employer, on the Ethereum to US dollars order book, there was effectively a massive market sell followed by a series of margin calls, which actually close out margin positions and force people to sell. So it was a cascade of sell orders, which actually ate through the entire buy side of the order book and pushed the price down to about 10 cents. Now, this was only in the one order book on the one exchange, so pretty quickly the price kind of reached back to where it is trading on other exchanges, but it was a flash crash last week.
And yet we're seeing more volatility continuing. Why is that?
So I think it's important to paint the backdrop of how this volatility is occurring. So at the beginning of this year, Bitcoin was trading for around $1,000, Ethereum for around $10. These are now trading for about $2,400 and about $240 respectively. So although we have seen a short-term pullback on those prices, I do think that the long-term trend here is very strong, and it's very clearly up and to the right.
That said, Fred Wilson, Union Square Ventures, says, "My gut says we are headed for a sell-off in the crypto sector, but honestly, I don't really care. I will keep buying into this correction or rally, whatever it turns out to be, because the more important question is where these assets will be in 5 or 10 years.
Yeah, I would fully agree with Fred there. When you think about this as a technologist, we're really seeing the early innings of a massive breakthrough technology that is far from mainstream right now. So I do think there is still massive opportunity here despite short-term volatility.
That said, it's pretty scary that the value could go to zero in a matter of minutes.
Well, so like I said, that was really the mechanics of one exchange, and that it can rebound very quickly. On other exchanges, it wasn't trading at zero.
How are these exchanges regulated compared to traditional stock exchanges?
So in the United States, they are regulated. Now, a lot of the trading activity in cryptocurrencies happens on non-US based exchanges, but when exchanges are based in the United States, the only difference is they're not really trading securities, they're trading cryptocurrencies. But otherwise, they're often federally regulated by FinCEN as a money service business or on a state level as a money transmitter.
Does this at all dampen some speculation that Ethereum could overtake Bitcoin in short order?
So I came on here actually about a week ago and said that I gave it till the end of 2018, and I would probably stick with that. So while I think there is definitely a pullback here in the short term, I remain long-term optimistic around the developer community built on top of Ethereum, that blockchain will enable new types of technologies and behaviors that the world has never seen.
What are analysts in general speculating on prices going forward?
I think the people that are deep in this space remain all long-term optimistic. Although there is always short-term volatility in this space, I and others have been in this for a very, very long time, and there's been volatility the entire way, but the long-term trend here has been substantial growth.
Now, one of the things we've discussed is that a lot of the traders of these cryptocurrencies are amateurs. Tell us about that and how it affects the way this plays out.
Yeah, so I think something that's really interesting about cryptocurrency is that most of the investors and most of the participants are not from Wall Street and they're not from Sand Hill Road. That is to say, they're not traders in public markets, nor are they venture capitalists in private markets. They're really computer scientists, technologists, and other types of early adopters on these platforms. So the value accrual here is going to a completely new group of people that's very atypical for investments you might see in private companies or public companies.
So should anyone be betting their kids' education on Ethereum or Bitcoin right now?
I think the asset class remains risky and not more than you're willing to lose. But I do think cryptocurrency offers an amazing diversification away from traditional assets.
So 10 years from now, what does this sector look like?
Well, I think 10 years from now, the market cap of all these assets combined is clearly into the trillions. And I think that these technologies will have fundamentally transformed major sectors of our economy.
So this is bigger than Apple,
This is much bigger than any specific company. This is as big as the internet.
Coming up, An interview from space, literally. We'll hear from NASA astronaut Peggy Whitson, the first female commander of the International Space Station. That is next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. Back in the day, NASA was the only game in town when it came to U.S. space exploration. But now there's Elon Musk's SpaceX, Jeff Bezos' Blue Origin. So are they competitors or partners in the race to test beyond the bounds of the Earth? NASA astronaut Peggy Whitson, the holder of the record for the longest time spent in space, joined the Bloomberg Daybreak America's team from the International Space Station and discussed how public and private space programs have evolved.
The place we are right now, the government can do more, but that is, for instance, we're seeding some of the money, seed money for some of the commercial providers. SpaceX and Orbital ATK are providing cargo up here to the space station. Hopefully in the next year or so, we'll be actually getting crews supplied by SpaceX or Boeing. And so I think the commercial to private, the government to commercialization is transitioning right now, and it's fantastic to see the cargo coming up on all these different vehicles. And I really do think it's the future because just like aviation, it has to expand in order to be really prolific. And having these programs in place now is definitely a stepping stone for further development. And that allows the government then to spend more money on going and exploring beyond low Earth orbit, which is what the current limitations are planned for some of the commercial providers. And we do hope to encourage them to continue on actually into further deep space as well.
So finally, Peggy, let's go way beyond lower Earth orbit. There's a lot of talk right now about colonizing Mars, actually going to Mars and living there. You've been living in space a fair amount of your life now over the last 15 years. Is that a realistic goal to set, to actually have a colony on Mars?
I do think it's a fantastic goal to have. We should have colonies on Mars and the Moon, and we should be expanding and exploring even further. So yes, and I think it's going to take some technology development, and we're using the International Space Station here to perfect some of those technologies. For instance, if we go on a multi-year mission to Mars, we need to be able to have a closed life support system, which means we need to be able to process our urine and make it into drinking water. We do that here on board the space station, and you know, we're at about 85% of what we call closing the loop of life support systems, at least in the water balance system. And so it's very exciting to be a part of those investigations, those testing, engineering and testing that's going on up here right now.
That was NASA astronaut Peggy Whitson speaking from the International Space Station. And that does it for this edition of the Best of Bloomberg Technology. We will bring you all the latest in tech throughout the week. Tune in each day, 5 p.m. in New York, 2 p.m. in San Francisco. And remember, all episodes of Bloomberg Technology are live streaming on Twitter. Check us out at Bloomberg Tech TV weekdays. That's all for now. This is Bloomberg.